Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Abbott Labs stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Abbott Labs is a medical device and healthcare company. It sells medical devices, diagnostics, branded generic medicines, and nutritional products. The company split off its research pharmaceutical business into AbbVie. That was back in 2013. The ticker for AbbVie is ABBV. Abbott Labs' well-known products are Pedialyte, Similac, Ensure, Glucerna, ZonePerfect, iStat, and many more. The company is headquartered in North Chicago, Illinois. It was founded back in 1888. The ticker trades on the New York Stock Exchange, Deutsche Borse, Mexican Bolsa, London Stock Exchange, Xetra, Swiss, Sao Paulo, Buenos, Santiago, and Kazakhstan Stock Exchange. Let's get started with the model. This is a large cap company, 211 billion market cap. They're trading at $120 a share, and they have 1.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see their free cash flow looks really good, growing from 4.5 billion to 8.6 billion. They have not released their first quarter free cash flow, so I used 2021, but it should be fairly similar. But the company has released its first quarter income statement, so that's why its net income and revenue are different from 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows every year, nearly 8 billion in the trailing 12 months. Revenue is a sales for the company, and that grows a few billion each year from 32 billion to 45 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at 25 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. A big operating expense for them is R&D, research and development. Gross profit minus operating expenses gives you your operating income, and that also peaked in the trailing 12 months at 9.2 billion. They spent 515 million of interest on their debt, a little lower than 2020 and 2021. Other income and expenses are the gains or losses not part of the company's core operations. An example of something in this category is a gain on the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which looks pretty good each year. Here's their first quarter income statement, first quarter 2022 versus first quarter 2021. Their revenue increased from 10.5 billion to 11.9 billion. Of that 11.9 billion, 5 billion is in the US, 7 billion is outside the US. And 1.9 billion is nutrition products, 5.3 billion diagnostics, 1.1 billion established pharmaceuticals, and 3.6 billion of medical devices. Everything is up compared to the first quarter of 2021, except nutrition, that's down 4.4%. The cost of sales is 5 billion, amortization of $500 million, R&D of 700 million, SG&A of 2.8 billion. Total expenses of 9 billion, that gives them an operating profit of 2.9 billion, up from 2.1 billion. They're paying a little less interest on their debt than last year, so their earnings are 2.4 billion, last year was 1.8 billion. Their diluted earnings per share are up from $1 to $1.37. They have a little less shares outstanding than last year. Last year was 1.79 billion, now it's 1.77 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And they generate a ton of cash flow in 2021, 10.5 billion. They spend a lot on CapEx, investments in property, plant, and equipment. They average about 2 billion in 2020 and 2021. Operating cash flow minus CapEx gives you your free cash flow. And they had a ton of free cash flow remaining in 2021, so they bought back lots of stock, 2.2 billion. Each year they buy back stock, 400 million last year, 700 million, 238 million. Every time a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. For the past 4 years, they've been paying down debt. Especially in 2018, they paid down over $8 billion of debt because they issued $4 billion, paid down $12.4 billion. So they decreased their debt load $8.4 billion. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And these are those numbers since 2015. And both of these numbers are at their highest point ever in 2021. And it looks like their revenue is getting even higher in the first quarter of 2022. Let's look at the capital structure. 36 billion of equity, 19 billion of debt. They're 65% equity, 35% debt. And their net debt is 8.8 billion. Net debt is debt minus cash. This is their capital structure since 2015. I like to see a company's equity balance higher than their debt balance. And it looks like since 2017, these two lines have been separating. In a good way, equity is getting further away from debt. And it seems like they keep a good amount of cash on their balance sheet at any given time. I gave them the lowest WACC on Finbox, 6.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 200 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $161 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of $92. They're trading at $120, so they're trading at a 31% premium. It's a sell according to the model. Here's their revenue projections from Simply Wall Street. Their revenue is projected to be $44 billion in 2024. Then $41.4 billion in 2023, $41.6 billion in 2022. So that's how I got their future revenue estimates. And I calculated $47 billion in 2025. Based off the growth of the previous 2 years. And they convert 18% of their revenue into free cash flow, so I multiplied their future revenue estimates by 18%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 126. They're saying it's 5% undervalued. 9 analysts priced this stock and the average price target is 142. The low is 135, the high is 151. This is where the stock has been trading the last 5 years, so it looks like it's only gone up. There was this dip during COVID, and the past couple months pretty much all stocks have been declining. This was over 140 a couple months ago, now it's sitting below 120. I compared this company's growth in the past 5 years compared to the S&P 500 and their competitors. Abbott is up 170% in the past 5 years. Edwards Life Sciences is up 263%. The S&P 500 and Stryker are up 82%. Medtronic is up 34%. I'll provide more detail on these other 3 companies when we do the company comparison later. They pay a quarterly dividend and grow it every single year. They're up to 47 cents a share, which is about 1.6%. And they can easily afford that. It's 38% of their free cash flow, 43% of their net income. Here's their dividend yield since 2011. Their yield was a lot higher in the past. It looks like it's coming down. And the forecast is for their yield to be 1.8% by the end of 2024. Their beta is below 1, so the stock is less volatile than the market. It's gone down 2.5% in the past 52 weeks, while the S&P is up 2%. The 52-week low is 105, the high is 143. And the stock is trading below its 50-day and 200-day moving average. 6 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 75% are held by institutions, and less than 1% of the shares are shorted. They've done 7 stock splits in their history. They did a 2-for-1 in 1981, 1986, 1990, 1992, 1998, and almost a 1-for-1 in 2004. And another 2-for-1 in 2013. A good sign is the company's employee count has been going up the past few years. They're currently sitting at 113,000 workers. The CEO's salary was $1.5 million in 2021, and their total compensation package was a whopping $25 million. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $50,000 today. That's a 17% annual return. In the past 12 months, there's been 3 insider sells. They all sold recently, so it's pretty close to where the stock is trading at right now. 3/4 of the company is held by institutions, 1/4 by the general public, and less than 1% by insiders. The biggest shareholders Vanguard at 8.5%, then Capital Research at 8%, BlackRock, State Street, and Geode. Let's look at their financial ratios. Their PE is 27, that's stock price over earnings per share. Price to sales of 4.7, price to book of 5.9, and their price to free cash flow is 24. They have a pretty good return on invested capital of 17%. They can easily cover the interest on their debt. They can cover it almost 18 times. They have a high ROE of 22%, a lot higher than the average and median in the market. They have a good current ratio of 1.8, that's current assets over current liabilities, and a good quick ratio of 1.5. They generated $8.6 billion of free cash flow in the trailing 12 months. They have over $11 billion of working capital, and they pay out $3.3 billion of dividend payments. So the company's really well funded. They have $16.5 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 153 companies in the same industry as Abbott, and Abbott is the largest company in terms of market cap. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in every category. Except price to book, they're a bit worse, and their 3-year annual growth rate is 12%, the average is 23%. They pay a good dividend of 1.6%. Medtronic pays more at 2.3%. Relative to their market cap, they bring in a good amount of earnings and free cash flow. A little better than Medtronic, a lot better than Stryker and Edwards Lifesciences. So to summarize, I have them trading at a 31% premium, but investing in such a big company in the medical field is pretty safe. That's always an industry a lot of money will go into. So in the long run, I think it's fine. In the short run, who knows what can happen because it seems like we're in a bear market. But a nice thing about their stock is you get their consistent dividend. I rank their free cash flows and revenue 8 out of 10, their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.